everybody. Welcome to Friday, another Talk Money with Tom show. We are here to try to help you make your retirement at least financially better. We do that by answering your questions. So you can send those questions in now to Ask Tom at talkmoneywithtom.com. You can put them into the chat here if you'd like also. We love to get questions during the show that we can try to, brainstorm and figure out for you also. So feel free to do that. Of course, we believe that the education of, this particular arena of retirement planning and asset management during retirement and the tax planning during retirement is really kind of lacking. It's not something we learn in school and those types of things. So we created this channel. I think it's a great resource. We have all kinds of different, videos on requirement distributions and distribution methodologies and whatnot too that I think are critical to making a retirement work. So you go to our channel, you can subscribe to the channel, you hit the little bell button to get notified when we put new content out and just start to increase your education. This channel is predominantly started for our clients, and we still believe very strongly that the clients need to have a higher level of education in these areas. We found that the more the clients know, the better that they do, even with our advice. So I think that's important. And then lastly, of course, you can meet with us. Client or non-client, please feel free. You can go in and book an appointment. On our website, there's a book appointment button, right? Looks just like that up in the corner. Our schedule's online. You can set up a time with Ethan and I for 30 minutes, phone, video, in office, whatever you'd like. We'd be happy to answer some of your questions too. So we put a lot of emphasis in this practice on education. And we're really proud of that, actually. Put out a video every single day about what's happening with the market. That's partly communication, but also partly educational, right? Just trying to get people to understand, the relationships from one thing to another. So I do always like to start off the show here with a breakdown of what kind of we saw happening for the week. I'm going to do this a little bit differently, not so many charts, just going to talk about kind of some of the things we see coming at us here, both positive and negative. Really, for the beginning of the year, it's a good time to talk about these kind of things. So just quickly, though, to review what's here on the chart, kind of a significant time frame right now.
Yep.
Yeah, I mean, this chart goes back to 2021. You can see the big run up there, very smooth in 2021. And then at the end of the year, it started to get a little volatile. November, actually Thanksgiving of 21 is when they started talking about raising rates. And so we hit a high. For our closing high was January 3rd of 2022, right? 47.97 if we round up.
Yep.
Yep. And so today we actually went above 47.97 for a little while.
Yeah, we opened the day really hot and then came back down.
Yeah, we had a gap up today, probably because of the earnings for the banks were pretty decent or what have you. And then we jumped up to this 48.02, right, just above it. That's what they call an intraday high. So the intraday high was actually set back on the 4th of January at 48.18. So we haven't broken that yet either. But I put a lot more emphasis on the close. We talk about that all the time. This green line is all closed dots connected together.
Yeah, most of the time when you're looking at prices and stuff like that for long term, you look at the close. You don't look at that intraday.
Yeah, exactly right. And intraday does matter, but I think we'll break both of those here. And one of the things that you look for, this is so common, and I've been talking about this since last year. At the end, you get up to these all-time highs. You don't just go sailing right through them, right? And you can see, we keep bouncing, we bounce down. That little down leg that we had at the very beginning of the year, if you look, the things that we're selling off are the things that made the most last year.
Yeah, and it's super common for most professional traders to take their profits at the beginning of the year after a good year.
Yep.
Because that allows you over the course of the year to then use losses against those gains.
Yeah, exactly right. And the other part that I think is important there too is that when you do take those gains off and you have cash on hand that you want to redeploy right into whatever other stocks, and so you can see a bounce back pretty quickly. And we have, and it's come right back up to where it was. It's very, very close today. I took a picture of this chart, as late as I could before the show starts. Matter of fact, we probably should keep watching it to see if we can close above 47.97. But the reason that's important is because historically, when you do get a new high, it can lead to a pretty decent 12-month run.
Yep.
On average, I think 13 out of the 14 last times that this has happened, we've had positive returns. Average rate of return is 13.9%. That's better than the average long-term return, which is about 10.9, 10.8%.
Yeah, the week started off pretty hot with tech running heavily, and then it kind of ran into a wall with the CPI being unexpectedly high.
Yeah, so that's one of the things that happened this week is that the CPI report comes out. It's higher than expected. Not a lot. For example, on core, it was at 3.9. They expected 3.8. So it was close. And the problem with CPI is, number one, the Fed's favored measure of inflation is not CPI. They have talked about the fact that they look at it, of course.
Yeah.
But it has this weird component in it for rents and
Yeah.
what they call owner's equivalent.
Yep. And the increase in rents for December were equal to half of the actual core CPI increase. So
Yeah.
and a lot of people see rent as kind of a sticky point.
And rents are strange. They're, generally speaking, longer term. Even if rents are coming down on new, existing rentals, you could have a 1-year lease and you're still paying that higher, so it's a weird measure. The PCE, personal consumption expenditure index, is the favored measure that comes out from the Fed, and it comes out at the end of the month, that the Fed pays much more attention to, and that core right now is at 3.15%.
Mm-hmm.
So today's number that came out that kind of got the market going, probably contributed to that gap up too, was what they call PPI.
Yeah.
The Producer's Price Index, and this is a wholesale inflation. I look at that as more important than CPI to a large degree. It's a bit more goods based than services, which may not be as accurate in today's economy, but it is sort of a future look. So if their producers are seeing lower inflation, eventually we might see lower inflation on the end product.
Yeah. It has CPI has a lag compared to PCI. So if you kind of like overlay the charts, you can kind of see like this how PCI what was going down before CPI started coming down.
Yeah, and so basically what they're saying now is because of the PPI that came out with a really good number today, is just the fact that we'll probably see PCE get below 3%. It's a projection basis, and that's a big deal. Again, we're trying to drive that down to 2%. But let's talk about some of the the things that are out there right now. What do you see like coming at us in terms of market forces?
So right now we're starting the beginning of fourth quarter earnings, and so anything that's super unexpected could change the market, especially with the bigger companies. So banking came in a little bit soft today. So there's financial, or just like banking and ETFs are done pretty poorly today.
Yeah, exactly. So it could be kind of an interesting time frame because you can get all kinds of volatility.
Yeah.
And it's weird. I've watched these earnings quarter after quarter after quarter. I think we've had 9 quarters in a row where 75% or more, maybe it's 70% or more of the S&P 500 companies have beaten expectations. And so, that's becoming sort of the norm now, right?
Yeah, but it could be that corporations can't take as much profit as they want to. Consumers aren't willing to spend as much money on products, and so we could see some of the or at least the good heavy companies coming down.
Yeah, we'll see how it plays out. I mean, one thing that's helped is that the Wall Street has been kind of pessimistic, and so the analysts have had expectations that are too low. I find it kind of ironic that so many companies beat expectations on average. So you kind of wonder about these expectations. They're basically wrong 3/4 of the time.
Yeah.
So or worse. So we'll see how that plays out too. So that's a big one that's coming on. But I do expect in the end to see some bump out of that, mainly because the very end is NVIDIA. And they're always kind of exciting, and all the other pieces that go along with that, with this artificial intelligence component. So what else do you see coming at us this year that you think is important?
So it's a lot about the Fed. How does the Fed handle the rates? Market's seeing many rate cuts, while the Fed's saying we're going to hold rates higher for longer.
Yeah, we just looked before the show. This is called for those of you that are interested, it's called the CME Fed Watch tool, and it shows the futures markets essentially bets on where the Fed funds rate's going to be after each meeting or at each meeting. So there's expected to be no changes whatsoever here in January's meeting. But if you look at that tool, it's basically saying we're going to have a 1/4 point drop at every single meeting for the rest of the year.
Which is another 7 cuts, basically.
7 cuts, right? And now the Fed, when they put out their dot plot, said 3 cuts of 1/4 point each, right, was their projections. And so they're getting a lot of questions all week. And that's been kind of created some volatility in the market in that, they're saying, oh, you're going to reduce rates. Market says you're going to reduce rates in March. And the Fed says, we don't see that.
Yeah.
Right? I happen to agree with the Fed. I'd be surprised if you had 7 rate decreases starting in March, mainly because if you look at the impetus for what would cause that, there's really only 2 main things that would cause rate decreases. Number one, a recession. We're not seeing anything in the numbers right now that's showing recession as a whole. There's pieces of the economy.
Yeah,
right?
there's pieces of the economy lagging, but the broader job market is still strong, and that's important to them.
Yeah, and that's their second mandate is full employment, which they consider really around 4% or better on unemployment, and we're at 3.7 right now.
Yeah, it came back down a little bit.
Yeah, so they're probably okay with that. They're feeling like they can keep rates up as long as because they have a dual mandate, right? Get inflation back down to 2% on core PCE, and keep employment unemployment at 4% or less, right? And so they're there, right? They're getting there. Matter of fact, if you take PCE for the last 6 months, it's about 1%. So if you annualize that, we're at 2%. Actually, we're slightly below it. I think it's 1.87.
Yeah, the last 6 months has been pretty good.
So that's the other reason, though, that rates can come down is deflation, right? So there's inflation when the rates go, the prices going up. There's disinflation, which is a weird word that came up here in this whole thing. That basically means prices are going up, but going up slower, like they should. Kind of getting closer to that 2% range. And then there's deflation, where prices are actually dropping. And I've said all week that as consumers, we love deflation.
I want something cheaper.
Sure, why not? I mean, if I buy a car, or, whatever it might be, we'd like to see prices dropping. But from a earnings standpoint and from a company standpoint, that's pretty disastrous, because you purchased and assembled, let's say, the car at this price level, expecting to get this amount, and all of a sudden you're getting less.
Yeah, basically you're wrecking your profit margins.
Yes, and that would create problem for the stock market. I know, like Kathy Wood, with the ARK funds, has been talking about the fact that we're facing deflation really since the beginning, and so that's probably more likely why they would be raising and lowering rates, just because I don't see recession coming up in the numbers here for the first 3 to 6 months of the year. Could still happen. I have no problem imagining recession, but I have a problem imagining it here in the shorter term frame. And so we've got the Fed basically, saying, hey, we can't see it. We don't see, what's happening. Now, what could happen before March, though, is if inflation continues to drop at a fast enough rate, they're only going to have, one PCE report before the March meeting, I believe.
No, they'll have
February too, huh?
Yeah, they'll have January and February.
Basically they'll have December and January because it's a month lag. Yeah. But so they'll get another data point. Is that enough to make them want to lower rates by 1/4 point in the March meeting? Just that's what the market's saying. So I don't know. So that will cause some consternation for the market when because here's what's happened, right? The Fed has historically, without fail, for the most part, unfortunately, they have over-raised rates. And they have a really hard job, because when they raise rates, the impact is 3 to 18 months from now.
Yeah, so you're turning a dial without knowing the exact where it's going to end.
Oh, yeah. It'd be like turn up the volume, but not hearing what that was for 3 to 18 months.
Yeah, you're not going to hear till the third song, basically.
Yeah, you have no idea how loud it is or how soft it is. And so that's the fear, and that's what the market is struggling with, is that the Fed's track record of over-raising rates is pretty profound. 2000 downturn, we had a 45% downturn. They raised rates 19 times, right? And probably too many in there. And then they're scrambling and lowering rates down to 0 or 1%. And in 2008 downturn, they raised rates 21 times. And again, scrambled back down to 0, created a massive financial, disaster globally. And I know actually Chairman Powell gave a speech before all this inflation hit of trying to change the thought process at the Fed so that they maybe don't create these big worldwide financial crises. I was very hopeful about that, but it was one speech, one period of time. So, we'll see what happens as far as that goes. But the Fed we talk about the Fed a lot. And I know that a lot of people want to talk about the president and the Congress and what have you, but the Fed is more important to the stock market. And so, that's going to be the issue. The market thinks 6, 7 rate cuts. Fed thinks 3. Market thinks March. Fed probably looking at June, July. Second half of the year for these rate cuts. And so, we're going to hear about that a lot too. So, what about the election? I've been getting a lot of questions about the 2024 and the possible really chaos that is coming at us from this election standpoint. Does that have a big factor on the market?
Well, if you're just looking at purely election years, the presidential election years, the market has overall, on a majority basis, has been positive. So that's a good factor for us. We don't know really. It's hard to predict an outcome, and like with the market reacting to something they can't really expect what the answer is going to be.
Yeah, exactly. So there's two points here. One is, what do you do about it, right? We react instead of project. So we could project and say, oh, the market's going to fall apart because of this chaos in the election. We're going to get more defensive. Good luck with that. I'll give you an example. So in 2016, when Trump was elected, it was a bit of a surprise, right? The futures market overnight was down about 800 points on the Dow, right? And so I got up early. I came in here thinking, okay, might get a lot of calls or, want to see what's going to happen. And no calls, market went up. The 6th of January, 2021, and the 7th, the day after, the Capitol invasion or whatever you want to call it, depending on your side of the political spectrum. But nonetheless, the market was up on both of those days. It's not what you would expect. Matter of fact, I had a client in December of 2020 talking about what she saw coming in terms of potential violence, and she was very nervous about what that was going to mean for the market. And it didn't mean anything to the market in the end. It's important in other areas, and maybe long term, there's some political ramifications. So I would say that we kind of have to just, play it by ear with what happens here on the political spectrum and see what type of impact that has. But I'll tell you, that statement I just made is not what people are thinking.
No, people have recent memories of pretty much the chaos of an election year.
But they attach very, very, very strongly politics, Congress, who has the White House with the stock market. And I'm saying, and I've been doing this for my whole life, started doing this when I was 12 years old, I'm 59 now. The correlation between, especially in the shorter term, in the memory that you might have, the next 12 months or 36 months, between who is in Congress and who is the president, isn't that strong. The Federal Reserve and what they're doing with monetary policy, interest rate increases, quantitative tightening, quantitative easing, you can make very direct correlations with that,
Yeah.
and even on a day-to-day basis.
The only time I'd say Congress or the president comes into play is when you have actual bills that get passed, whether it be a tax cut. So tax cuts, the 2017 tax cuts,
Right.
definitely corporations, flew off of it. It had it up from that.
We had a nice run, and actually you could probably blame that last big COVID bill that came in early 2021 with the spike in inflation. It might have been the piece that pushed us across. It's hard to tell. Can't go back and take that out. But if you look at the inflation chart, it took off right after that money was pushed out the door. So that's something that came politically. There's things that do happen, and there are some correlations there. I was talking to a client the other day, and the current administration, I think the Fed so far has done a really good job. And I think Chairman Powell has done a really good job communicating. And he was actually appointed by Trump and then decided again to be appointed by Biden, or the administration anyway. And I think that's something that happens by whoever's in office. I think Yellen personally has done a decent job as Treasury Secretary. She used to be Fed governor also, which I think is an interesting role. So there are some pieces, but I don't know that this election's going to be, and what might come from that might be the biggest issues.
I don't think the actual election is going to change anything. It's if what comes from the election. So whatever legislation is passed, but you won't have movement until that those bills are actually passed.
Always ask yourself, in my opinion, how does this impact company earnings, right? And I think what's happening in the Red Sea potentially has more chance to impact company earnings
Yep.
than what might happen in our presidential election. Now, I actually think the Red Sea is probably going to blow over. You're talking about, is Houthi, I believe is how you say it, right? Not a huge group with lots of power. The U.S. and U.K. are launching, retaliatory strikes as we speak, and all this stuff. But the concept of the Red Sea is that 15% of world commerce goes through the Red Sea. So if somehow you cut that off, you have a situation where supply dries up, and when supply goes down and demand stays the same, prices will go up, and we're already in an inflationary environment.
Yeah, and you have to think about what goods goes through that passage. Oil is a very prominent one.
Yeah.
I know a lot of Chinese trade to Europe goes through that Red Sea. So you have to think about what companies will be affected.
And oil is just a dramatic asset, right? I mean, because if it goes up in price, it's at like $70 a barrel right now, so it's really, really a good price. Was at 130 right after the Ukraine invasion, but it has that capability of creating some higher inflation really quickly, because it's not only powering our cars, and for the most part, but it's powering all the trucks and trains and everything that's getting the products and goods to you. And so when that goes up, it can kind of be an inflationary spike. And if you look at what happened in the 70s, that was we looked at that chart some time ago on the show. It went from $4 a barrel to $40 a barrel over a 7-year period. That's going to create inflation. So those types of things are, we always watch out for and see how that plays out. I don't think it'll be a big deal. Normally conflicts, I actually thought the Ukraine would be a bigger deal, at least with the price of oil. A lot of people talking about oil going to $200 a barrel at that time. Yeah, I saw one lady talking about an oil analyst going to 260. We're at 260 right now, our inflation rate probably wouldn't be coming down, right? I mean, it would be a problem. So the issue with oil, though, that has changed dramatically is that the U.S. produces so much oil now themselves. We're actually a net exporter of oil, and so that's been much more difficult for OPEC or any of these conflicts to really create a higher oil price. So we're in a different spot than we used to be. So I think those are some main things that are coming at us, with the Fed, with international conflict, dealing with the presidential election. These are things that are happening. I think we're going to break into a new high. It's taken us a little bit of time. We do want to watch out for that double top.
Yeah.
But if you look at most double tops, they're not quite like that. Matter of fact, if you look at the top that we had, see how it just kind of didn't spend much time there, and it's pretty steep on each side. That's more what a double top looks like. When you start continuing to hit it over and over really close, that means you're probably breaking through. I mean, there's a signal here. Even yesterday, the market's down 0.8% and then rallied all the way back up to essentially even, right? That's just, there's this power. It just wants to go. And I think it will break through and go as far as that goes. But that's, probably a little bit of run from that if we get through there also. Things are pretty good. We're still a little stretched out, that big run we had. There's some pieces that'll slow us down, but overall, I think, the Fed motion to lower rates or stop raising them is a really big boon to the stock market. Historically, it has been anyway. All right. That's good. All right, so thank you for joining us for our summary for what we kind of saw happening. We're going to answer some of the questions that have come up either in our, client interactions or client strategy sessions, or come in live here.
So my long-term carrier policy is increasing its premiums. What are my options and how do I evaluate them?
Yeah, so it's kind of interesting. So long-term care, I remember, 20 years ago, quite inexpensive. Lots of people out trying to sell it, and wholesalers knocking on the door all the time. We specialize in retirement, so hey, we got this great policy and this is how it works. And then all of a sudden, all those people bought policies
Yep.
and got to an age where they're starting to use them. And we are seeing from clients, asking us for their help on an analysis basis. Uh, what do we do? Because now they're talking about raising our fees dramatically, and or cutting our benefits and what have you. I think it's really kind of sad. It's basically the insurance companies were gathering money and not paying it out for a long time, and now they have to pay it out, and they're starting to go sideways on it.
Basically, the insurance or a lot of these companies undercharged
Yeah.
for what, so they expected a lot of people to drop these policies over time, and just not live as long and not as need as much long-term care.
Yeah, they missed it on the actuarial basis, essentially. I mean, because that's
Yeah.
how they look at it, right? And they've done that before. I remember they had these riders on the annuities, these lifetime income riders, and there was a guaranteed pool that was growing at 7%, and there was some good-looking deals. And 2008 happened, and they all abandoned those things. They kept the old ones, but they wouldn't do any new ones.
Yeah.
And to me, that means the consumer was winning. The insurance company got it wrong. So that's probably exactly what happened here, is that the consumer was winning and the long-term care policies being inexpensive, and they just missed. Long-term care insurance has gotten to be, long-term care itself, expenses have gotten to be pretty incredible. I've heard some unbelievable numbers from some clients, that are either have spouses in care or have friends with spouses in care, or friends in care, and it's incredibly expensive.
Yeah, and so usually, what are your options? So in California, they essentially have, you can keep your current policy and just pay the increased premiums. That's one option. Your second option is to negotiate with them. California requires that any policy to be able to lower your benefits for a lower premium. And then the third option, or there's a couple other options, but a third option is to ask for a paid up option. Essentially, they take whatever premiums to be paid and then pay that out as your long-term care. And then
They usually give you a little factor there too, right? So if you put in 50,000, you might get 75,000 worth of coverage. So like 1.2.
It depends on when
something.
they're doing the settlement.
Yeah.
Or when they're providing these options. So it's usually at least 1x your premium. So at least you'll always get your premiums back. And then your final option is always to walk away. But at worst, you would always take that paid up option.
Yeah. So a paid up option means you don't pay anymore.
Yep.
Right. And so they're done, and you get your money back and maybe a little bit more depending on what factor they use. So yeah, you wouldn't want to walk away versus that. At least you got something there. But if they're, so that's the tier. Keep it, pay more. Yeah.
Yep.
Maybe pay the same or a little more, and have less benefit.
Yep.
Yeah. Or do the paid up option. Those are the big ones. There's other things that come into play, and what have you too. But that's the analysis. And so, I mean, what are some of the things that we would want to look at to analyze that?
So long-term care policies are policies that don't return premiums so if you pass away, the policy's gone. So it's kind of like a probability game. So does your family have any history of needing long-term care? So if you have someone if dementia runs on your father's side of the family, I'm going to say you should think about keeping this policy, even if it's just a reduced benefit.
Yeah, exactly. It's, we have clients using long-term care insurance policies, and they're really, really happy that they have them. So, again, it depends on a lot of things. I guess one of the things I'd throw in there as part of the analysis, besides the medical side, is just, their overall financial situation. So what if we run their plan, run it through a long-term care scenario without a policy?
Yeah.
What happens? So if they're in the high 90s on probability of success and it drops back to 60s, oof, man, you might need to pay even if it costs more, versus somebody who has very little change in their probability of success. So because they essentially have some self-insurance with enough money in place, then maybe they could take the paid up option or at least the reduced benefit option and try to keep their outflow the same. So I do think that you'd want to run that through a plan and take a look at it and see what type of impact would this have on me or me and my spouse.
Yeah, and the next thing is to think about what is the paid up option or the reduced option.
Yeah.
So let's say I am 85, I have the option that my premiums are going to double. I can't afford doubling my premiums. What can I give up? Maybe I have an inflation policy on my long-term care benefits, and so I don't. Maybe I'm at a point in my life where I don't need that inflation policy anymore, and so I can give that up while still maintaining that lifetime benefit.
Yeah, because a lot of times you'll see a policy with like a 5% increase. So the benefit that you have might start off at a certain level, but then it grows 5% every single year. So if I'm 55 taking that policy, that's a big deal. Because if I'm going to get the same exact amount when I'm 85 and need it, it's not going to be much money, right?
Yeah.
So that rider is really important. But now that I am 85, it's not as important.
Yeah,
right.
Because if I'm using it in 5 years,
right.
5% inflation,
right?
You can manage it. You can manage it.
Yeah, it'd be nice to have, but if it means paying double or triple or whatever it might be, maybe it's not worth it. So it's kind of different based on where you're at, and this is unfortunate that we're even having to go through this. There's no institutional situation here that can take care of you if you have any money. We do have Medi-Cal here and Medicaid for the rest of the country. That will pay for your long-term care, but it's so restrictive in terms of what money you can have.
Yeah, essentially you have to have nothing left, or basically nothing.
But it'll feel like it, that's for sure. Yeah, and risk damaging your significant other too. So that's where the policies are important. And so this is an issue that just keeps coming up. People send us the letter, and we do the analysis and give them some feedback on some of the options. Even doing some conference calls with some of these companies to try to, get more feedback on a live basis on what some of the options are. And you can extend oftentimes the period to decide if you just ask, because sometimes it takes a little while to really, analyze it and figure out what you're going to do. It's an important decision, both from a cash flow standpoint and the possible coverage standpoint, that you might need in the future. So. It's a good question.
So, what should I be doing with CDs? I have a few that are maturing soon.
Yeah, this is a conversation I've been having with clients. We did a lot of CDs for our clients. It's a free service we do for the clients. We can do these brokerage CDs. I think they're kind of neat. You can get multiple banks all in one statement. It's simple as far as that goes. And for a long time here, we've been doing pretty short term because rates were going up and up, right? They kept raising rates. So you do a 3 or 6 month, it comes due, you're getting a higher rate, right?
Yep.
So now your situation is quite different. And this is where it gets kind of confusing for people. So Federal Reserve says rates are going to drop by 0.75% in this year on their dot plot. The market says the rate's going to drop almost 1.75%,
Yep.
right? Okay, so what do you want to do in that environment? Do you want to stay short term, and every time your CD comes due, it's going to be coming due potentially at a lower rate? No, you really want to go a little bit longer term, and I've been advocating kind of a ladder. And so we do have a visual here. This is from today. This is from Schwab, right? From their CD and bonds quotes, so to speak, and these are probably averages or the high or what have you, but you can see you can still make more money on a 3-month basis, right? 5.2 essentially, versus a 1 year is 4.8. So why would you take 4.8?
Well, yeah, but the problem is every 3 months you have to renew that 5.1, and so once that 3 months falls below that 4.8, that's when you start to see the 4.8 pull ahead.
Yeah, if you did 4 3-month CDs over the next 12 months, you might make less based on these projections for interest rates than 4.8%.
Yeah,
if you took that 1 year.
And we've seen the interest rates come down. Like a few months ago, the 1 year was about 5.1, 5.2.
Yeah.
2 years about 5, and so you can start to see that these interest rates are coming down.
Yeah, they're coming down already. So that's where I think like a 1, 2, 3 year ladder here would be an interesting concept. So a ladder is maybe you take a third and put it into 1 year, a third into 2 year, a third into 3 year. And even though it looks like you're making less, you might net a higher amount if rates do continue to come down. So it's an interesting place, and maybe you throw in a 6 month into that ladder because there is a chance here if you look back in the 70s, rates started to soften, and then they lowered rates, and then inflation got out of control to the upside. And boy, there was a point in time where money markets were paying 15% and such too. So, so you can't say for sure rates are going to come down, but they are coming down. The projection is that they're coming down. You'd want to go a little bit longer term in that environment, in my opinion. And so that's how I would look at it. A brokered CD doesn't have a penalty. We could sell it. So if this liquidity is an issue, you can get out of it. You might get less.
You might not get any interest. Essentially, you might sell it what is the par value.
Right.
You bought.
Yeah, but you could get more too, because if rates do come down, if you've got a 4.8% 1 year and the new ones are coming out at 4.5, when you go to sell your 4.8, it's worth more.
Yeah,
it'll be worth more. So, there is some liquidity there. I generally advocate not thinking about that. Just let it come due. Make sure it's money you don't need, type of thing. But it's not a bad place. Now, these become not as popular. When we were doing a lot of these, the market wasn't doing that well.
Yeah.
And now all of a sudden people are looking at that and saying, well, 5 isn't that great. The market just made 8.9 in November. Yeah. So when the market starts to go, people do start to take a look. And that's on a macro basis, that's what makes the market go. When the market starts to go, all of a sudden money that was kind of coming out and going into money markets and CDs is now starting to come back. And so that's why we're seeing kind of this almost vertical rise in the stock market, is because, again, people are looking for what they would consider the, highest return they can get. And CDs have a place as part of an overall asset allocation, in my opinion, irregardless of what they pay.
Yep.
But, it's an interesting time because they're paying so much more than they did, right? These still aren't these rates, looking back in my lifetime, 4.8 for a 1 year isn't that spectacular. I've seen way better than that.
Yeah, if you're looking at the last decade, though.
Yeah, but it's been a while. So we've got accustomed to 0.15% or something on the 1 year. So it's nice to see them come up. But that's a good question. It's been coming up quite a bit. All right, what's our next question?
So how does the Red Sea situation affect the U.S. market? You talked about the global market, but what about the U.S. stock market? How does that affect?
Well, oil affects every market, including the U.S., so that's a big one. If oil can't transport through there, if it has to go, other directions, to the long way, so to speak, to get to where it needs to go, that could impinge the price of oil. We have seen some movement, not big, but some movement in the price of oil as this conflict has heated up. But I guess the Red Sea thing has more potential to be a bigger event in the end, right?
Yeah, it could be a powder keg. It could spread to other countries. Right. Then it becomes a bigger deal. And
that's an oil-centric area of the world, right? And so if you have, Iran getting involved here, that kind of thing, that oil would be the key thing I would be looking at in terms of the U.S. Most of the transport of goods through there, as you mentioned, like China puts their goods through the Red Sea to get to Europe. So probably has more impact on Europe on that kind of goods side, if we ignore oil for a moment. But that's the biggest issue. Normally in a conflict, the market drops at the beginning of the conflict if it's big enough to capture attention. I don't know if this is there yet, but the situation in Ukraine, for example, the market dropped.
Yeah.
And then the market starts to ignore that fairly soon and actually starts to come up oftentimes during these conflicts. We saw that during Afghanistan. We saw that during both of the
market gets used to it. It becomes a new norm.
Well, and unfortunately, money's being spent to do these things. And so there's a kind of a stimulus that comes out of these conflicts. So that, we'll see how this plays out. But that's not usually the big issue, but you can have a drop, in the short term, certainly, as things, if Iran all of a sudden escalated and got involved and we were in a conflict with Iran, I bet you anything the market drops at the beginning, right? And then maybe it settles down after, who knows? But, we haven't had any nuclear conflicts before, so we've never experienced that. Hope we never do. But there are lots of different possibilities that are out there. Matter of fact, you can have the best projections ever for what's going to happen in 2024, and you get derailed by an international incident. I always call that kind of the outside, forces that are there, and they're always there.
Yeah, the black swan event.
Yeah, anything. It could be the Taiwan situation with China. It could be, the Middle East scenario. It could be, anything. And so that's always at play. It's always a risk category, and it's why you always have to keep your portfolio well diversified and exactly in the mixture stock and bonds that you really feel like you can afford some type of downturn, and be able to wait for it to come back. So that's why we advocate for that so much. All right. We have time for one more.
So how do I calculate how much umbrella uh, coverage I need for my insurance? Umbrella policy is kind of just a policy that you overlay on top of your existing other liability insurance.
So basically, you'd have your home insurance, your car insurance, et cetera, and you'd have an umbrella policy over the top, basically just magnifying your coverage,
Yep.
Essentially. And so, why don't you go ahead and tell, because we just did a calculation on this for one of our clients.
So the idea is that you take your net worth, and then you start to subtract on how much of that net worth is going to be at risk. So your primary residence will always be protected. So you just take that off. Next, you take off your kind of your company and your IRSA protected pension or your retirement plans. So that's also protected. And then IRAs, it depends on your state. So California, an IRA is protected up to whatever the judge determines you need to be like, okay. So the government doesn't want to leave you destitute. So they will protect you somewhat, but they can still take some. And then inherited IRAs, trust accounts, all that other kind of property is up for grabs, essentially. And so once you get that, so you take your net worth, you minus off what's protected, and then you kind of end up what's up for risk. That's how much you kind of want to get your coverage to cover after you minus off what your current insurance liabilities have.
Yeah, so theoretically, you can minus all those things out of your net worth and end up with nothing that needs to be covered.
Yep.
Or it could be, $2-3 million that's still exposed that needs to be covered.
Yeah, and so umbrella cover insurance is actually relatively cheap, and they usually start at increments of $1 million and go up $1 million at a time. Usually the cutoff's at $5 million for a lot of these companies. But it's just nice to have. It's a cheap insurance policy that kind of protects you from those really catastrophic lawsuits.
Yeah, we have some clients that have done more than 5 million. They end up going to basically some specialty brokers, and it's a bit more arduous. You can still get it, especially if you need it. It's nice. Personally, I like insurance just for myself. I've wasted a lot of money on insurance because I hardly ever. I had one flood in my house that I claimed on. Probably the only thing I've ever claimed on my whole life. But it just makes me feel good to have it and make sure, that I don't have there's enough risk in life as it is, and, what have you, to kind of insulate myself from some of that risk.
And the nice thing is when you have this umbrella coverage, the insurance company is the one fighting for you. Mm-hmm. It's not you that's going to go up into this lawsuit because they have a vested interest to not pay any money. They don't want to pay. So they're going to try everything in their power to protect you.
Yep, sounds good. All right, well, that's our show for today. Where'd the market get to? Did we get to our high? Let's see here, just real quick.
So it went to 484. So
488.
No, 4784.
4784, and the high was 4798.
Yeah, so it's
real
slightly positive, but
slightly positive, but didn't quite make the high. But we broke the high intraday. That's a good sign. We haven't done that yet in this upturn, and 4784 might be the highest we've seen since that high, or at least in this recovery since October of 2022. So yeah, anyway, it's kind of a watch thing. I do the videos every day talking about the market. So we'll see what happens on Monday. Maybe we'll be talking about a new closing high. We'll see. It's trying. It really is. You can see it. All right. Well, thank you everybody so much for coming. Again, you can send your questions in during the week. Send them to the Ask Tom with talkmoneywithtom.com, and give us a little chance to analyze them. Maybe find a chart or something that might help. Secondly, of course, continue your education. Subscribe to the channel. Hit the bell button. Take a look at what's on there. I think you'll get something out of that. And then lastly, of course, you can meet with us. We got a book appointment button on our website. You go in there, push that button, and we'll be happy to spend 30 minutes, talking to you about your specific situation. So I want to thank everybody so much for coming. I look forward to seeing you again next week. Thank you.